how far this can go, I think the most important point is that you are entering or already in easily the seasonally strongest period for markets year after year after year, and that's compounded in midterm election years as well. And I think with the tailwind of how far you'd fallen, the better than expected, although not good at all, CPI report that we had, and then hopefully a cooperation and other data points.
Well, it was good relative to where we were. I mean,
relative and absolute.
Obviously, it's not great when you're doing 7.7 on inflation, but relative to where we were, I mean,
sure,
can we make some incremental steps in the right direction?
Yeah, but listen, we've talked about this all year. It's important for people to remember that for the viewers, that the year-over-year rate doesn't matter. You want to look at the month-over-month rate because of the nature of the way of what we call base effects. Almost any outcome would result in a decline in the year-over-year rate. What you want to look at is the month-over-month rate.
So are you suggesting that we did too much too soon in the market on the back of the CPI?
I think when you have one of the 10, 15, 20 best days in modern market history.
I was going to say, we only did a year's worth of gains in 2 days. What's your problem with that?
That's true for the NASDAQ. That's true for the S&P. It's true for small caps. Those types of days. Now, let's pivot to another conversation here. The idea is that those types of days only occur in bear markets. And that's not totally true. They do occur in bear markets. Most notably, the most egregious upside gains occurred in October of 2008 when you had 5, 6, 7, 10% swing days each. But another day occurred the day after the bottom in the COVID low. You've had other bottoms in previous bull markets. So the idea that somehow that only happens in a bear market is not borne out by the data. It could be signaling something of a bottom. I don't think that's necessarily the case.
I mean, there are some who are, even the more negative voices over the last many, many months. Mike Wilson, for example, over at Morgan Stanley, says you could go to 4150 or above. That was the top of his range, but he still thinks you're going to go to new lows in 23.
Yeah, because that camp in which I have long been is simply arguing that you can't have 500 basis points of rate hikes in, call it, a 12-month time frame and only see its effects manifest itself in the housing market. There's just it's hard to believe that you're not going to have further declines in the manufacturing sector. You're not going to eventually have at least a slowdown in hiring, if not outright layoffs. And that tends to occur, or that assumed to occur, let's call it in the first half of next year, maybe the third quarter.
Do you normally, though, have that magnitude of rate hikes at a time where the economy started off at such a high level?
No. Well, listen, we haven't dealt with anything like this in 40 years. And also, I would argue, on the positive side of things, and I think we have a chart of how much money people are sitting on. Just to remind everybody of the obvious, we gave everybody $1 bazillion. Here it is. This is the change in consumer banking, cash that people have in their bank account, the percentage change for different wealth quartiles since the start of the recession in 2020. And you can see, no matter where you fall on the income or wealth spectrum, you have infinitely, you have exponentially more cash in the bank account.
It was infinitely.
Oh, yeah. Don't tell me about it. But you have exponentially more cash in your bank account today than you did at the start of COVID. And that's providing an important ballast against some of the negative headwinds. So to your point, you've never had a situation like this before. I think those of us in the bearish camp are just sort of operating under what I've often referred to as this expected value outcomes.
Yeah, but are you appreciating the cushion that we started with enough?
Maybe not. I think I am. Obviously, I think we all are. But again, when you deal with 500 basis points of rate hikes in 12 months, you're going to see a labor market slow down. How much it slows down remains to be seen.
You're already seeing it, right? Amazon today. These reports of 10,000 workers. You've had, number of layoff announcements already, thousands and thousands of workers within tech, especially.
You have seen it in the anecdotal data for sure. Disney is sort of the first non-tech company of some large size to start announcing layoffs, but you haven't seen it in the macro data. The jobless claims number still remains exceedingly low, and the monthly jobs report is still quite high at a couple 100,000.
What about the comments today from Brainerd, Vice Chair Brainerd? Quote, I think it will probably be appropriate soon to move to a slower pace of rate increases. So they're obviously going to slow down, and they're probably going to slow down next month, right? The chances of 75 are, I think, growing slimmer. Wouldn't you agree?
I would agree. To be clear, there is a monthly jobs report that comes out in 2 weeks.
So the CPI,
and then the CPI the day before the decision, the day of the meeting. So there's two and there's retail sales. And this week brings a slew of reports from retailers who are going to give us some up-to-date data, or at least anecdotal data, on the consumer. So there's a lot between now and then. But yes, the likelihood is that they slow down to 50. But I would also add that she's not really telling us anything we don't know.
No, obviously, right? Yes. I think it probably will be appropriate soon to move to a slower
You're not going to
pace,
hike 75 basis points in perpetuity.
No, but she wouldn't say that if she didn't think that they were, A, starting to do what they need them to do, and B, that inflation has peaked and it actually is trending in the right direction. So we can give her, a little bit of credit on the thought of where we are going forward rather than just say, well, obviously. Yes,
no, I agree. And listen, you can make a strong case that they should slow down. But the argument isn't, are they going to keep hiking in perpetuity? Now the issue is, to what level are they going to go? And even more importantly than that, how long are they going to leave it there? And that's something that nobody's going to opine on just yet because there's 17 pieces of data between now and the February 1st Fed meeting.